Gold just had one of the biggest runs in a generation. So why did a fund stuffed with gold companies climb almost twice as fast? That gap is the entire story behind GDX. GDX is the VanEck Gold Miners ETF. It launched back in 2006, and it is the largest, most heavily traded gold mining fund on the market. Instead of holding gold bars in a vault, it holds the companies that dig the metal out of the ground. With roughly $27 billion in assets, GDX is the default way most investors get exposure to gold miners. It tracks the MarketVector Global Gold Miners Index, a basket of about 50 mining companies from around the world. Open up the fund, and you will find names like Newmont, Agnico Eagle, and Barrick sitting right at the top. The 10 largest holdings make up around 60% of the fund, so a handful of giant miners drive most of the movement. When you buy GDX, you are really buying their profits, their costs, and their mines. Here is what the marketing does not put front and center. Gold miners do not move with gold. They move faster than gold, in both directions. When the price of gold rises, a miner's profit can jump far more because the cost to pull an ounce out of the ground stays roughly fixed. That is called operational leverage, and it is exactly why GDX can soar in a strong year for gold. But that same leverage cuts the other way. When gold drifts sideways or falls, mining profits can collapse, and GDX can drop much harder than the metal itself. Add in mine accidents, rising energy costs, and the politics of operating mines across dozens of countries, and you are taking on a stack of risks that a simple gold bar never carries. Over the past year, that leverage paid off in spectacular fashion. Gold itself climbed roughly 40%, while GDX returned well over 60%. That is the dream scenario for miners. Just remember that the years it works in reverse rarely make the headlines. So who is GDX actually for? It fits an investor who is genuinely bullish on gold and wants amplified upside, and who can stomach stock-like swings to get it. This is a leveraged bet on a commodity story, not a quiet safe haven you tuck away and forget. And at an expense ratio of about 0.5%, with a dividend yield under 1%, you are paying for growth and volatility here, not income and not cheap insurance. If this cleared up the difference between owning gold and owning the miners, hit like and subscribe for more plain English ETF breakdowns. And tell me in the comments, are you team physical gold or team gold miners? I read every reply.